Hi, everyone. Welcome to Asset TV. 2025 was a record year for municipal bond sales, and analysts forecast a similarly active 2026. So the question is, what's behind the surge, and will the fast pace of new debt offerings impact the market's longtime reputation for credit quality? Well, here to help us tackle those questions and more is Seán McCarthy, Chief Executive Officer at BAM Mutual. Now, I want to start by saying municipal bond issuers sold $580 billion of new issues last year, and the forecasts are for 2026 to match or exceed that. And the question here is, what is driving those forecasts? And with that, I turn to Seán. Hello and welcome.
Thanks. Great to be here. I think what we want to do is take a step back and look at what happened to the market post the Great Recession. So right after 2007, essentially, infrastructure was flat for a decade. If you look at what happened since 2022, the growth in the demand for infrastructure finance has increased by 43%. So that's just a huge amount of growth and demand that has to be met. In fact, if you think about what the American Society of Civil Engineers says, their prediction is that there is between repairing and maintaining existing infrastructure and building the infrastructure that should be coming online, that the demand is $9.2 trillion over the next 10 years. That's just an enormous number. And so what we think is 2026 will be at least as large in terms of volume as last year, because across all boards, power, hospitals, roads, essential infrastructure, the demand's enormous, and we think it will be met through the municipal bond market.
Now, Seán, supply is one side of the equation, but is demand keeping up?
So if you think about the investment side, the demand for investing in municipal bonds, mutual funds have increased in 2025 by $52 billion. Individuals in the municipal bond market have increased their investment in the first 3 quarters of the year, according to the Fed, by $100 billion. So that's an enormous amount of demand for municipal bonds to be invested. And so if you compare that to what we think the growth opportunities are right now, it's really in retail or proxies for retail. So separately managed accounts are a major growth factor. They had a record year last year. We think they're going to have a record year this year. And we think that given what's happening in the environment, that long-term investment in infrastructure through municipal bonds is likely to be robust over this year and looking forward from there.
How about BAM's activity specifically? Can you go into detail about that?
BAM had a record year last year. The industry had a record year last year. BAM guaranteed a little over $21 billion of par last year. We guaranteed bonds in 40 of 50 states and the District of Columbia. And that cuts across all kinds of asset classes, so that it's not just small state and local schools, but it's airports, it's bridges, tunnels, hospitals. It cuts across all forms of infrastructure, and we think that's here to stay.
Is that translating to, increased demand for insured bonds?
One of the things we see happening in the market is greater credit differentiation. Again, go back to what happened in COVID. The federal government came in and provided a tremendous amount of economic support for state and local governments in order for them to just continue to operate. That money and those programs are winding up. And so the burden of funding infrastructure falls more directly on state and local governments going forward. And in that case, not all state and local governments are the same. Not all cities are the same. Not all counties are the same. What we see as differences between credit strength among credits. And so one of the things that insurance does is it protects against default. But what we're doing for a living is analyzing carefully credits and then putting our AA guarantee on top of those credits to make sure that investors retain their value.
So we're moving into budget season for a lot of states and cities. The question here is, what should investors be watching for, Seán?
So that's a good question as well. I think the thing to look for is economic environment. So when you're looking, a lot of people buy bonds right in the communities that they live in. In many cases, those are triple tax exempt as a result of that. So the things that we focus on are how many initiatives have they approved through a vote? what their commitment is to the strength of the revenue streams that support the economy within their locality, whether it's a small town, a school district, or the state itself. So we see that 2 years ago, growth was about 5%. A year ago, it was 4%. Last year was actually down 2%. So that means that cities and states, according to the National League of Cities, and we have a very close partnership with them, are really focused on creative and assertive ways to try to get these essential infrastructure projects financed in the market.
So as we wrap up this conversation, in sum, how do you see it all shaping up in 2026?
Well, I think it's going to be a growth year. I think there'll be winners and losers in the market in terms of how they proactively address these issues. And again, the burden is really on local governments, as I said before. That's the most important thing to remember. The federal government, as we think about it, is not the primary financier or funder of these essential projects that you think of in terms of roads, mass transit, hospitals, and schools that you live by. And the final growth thing I think that everybody's talking about right now is power. If you think about the demand that we talk about AI and how much power that's going to consume, that power by and large will be financed in the municipal bond market.
All right. Well, Seán, thank you so much for joining us here in our New York studios.
You bet. This was great.
Yes,
anytime.
It certainly was. And we want to thank you, the audience, as well for watching. That will do it for us here on Asset TV for now. I'm Michelle Yu. We'll see you next time. Take care.